Okay, so let's get into this episode, number 316, Why Asset Allocation is So Important. You know, I had the opportunity to meet with just a lot of wonderful people around the country and help them with their retirement planning. We also had the opportunity to look at how people have been investing. And now that the stock market has almost fully recovered, this is a good time to reevaluate your asset allocation strategy and consider making some changes before the next big thing hits and causes more volatility, especially if you have retirement on the horizon. As I've met with people around the country, I've found that many people don't really have an asset allocation strategy. Many people just have made investments in various mutual funds with no real guidance on portfolio construction or asset allocation. They just know that they should have some money in stocks, some money in bonds, and some money in cash. And this is just a real basic understanding of asset allocation. But in today's show, I want to explore why the subject is so much more important than just that simple structure. And my hope is, after our time together, you will see why asset allocation is so important, especially in a drawdown scenario when your ability to earn or your human capital is gone. So risk is different once you retire, and it's different in the sense that you're no longer saving and accumulating, because during that time, risk is really just noise. But if anything, volatility helps you accumulate wealth, because when you're making regular contributions and dollar cost averaging into the market, volatility allows you to buy the dips. So I've heard the analogy, and people compare investing to climbing Mount Everest. Climbing Mount Everest would be like the accumulation phase, whereas the distribution phase would be like coming back down off the peak from Mount Everest. And many of you know this, but the interesting statistic is that more people die coming down Mount Everest than going up. An article in Scientific American said that only about 15% of deaths occur from attempting to scale Mount Everest, whereas 56% of the deaths occur on the way down. And the analogy helps us understand that sometimes the way down, or the distribution phase, can be more important than the way up, or the accumulation phase. Today's show is focused on the distribution of wealth, which is so much different than how most people think. Many of the investment podcasts that I listen to are focused on the accumulation wealth. And very few of the shows that I listen to are actually talking about portfolio distributions, or how asset allocation is applied in the distribution phase of retirement. So let's start out with answering kind of the most basic question. What is asset allocation? Asset allocation is balancing risk and reward by investing in different asset classes, with the expectation that not all asset classes move in tandem. It's finding the sweet spot on the efficient frontier that maximizes returns for a given level of risk. And if you'll remember from show 315, we talked about modern portfolio theory and the efficient market hypothesis and the efficient frontier. An overly simplistic example of asset allocation would be to determine how much to hold in cash, how much to hold in bonds, and how much to hold in stocks. Asset allocation even more simply means not having all of your eggs in one basket. In order to create an asset allocation strategy, you would want to understand what the rate of return required is to meet your future cash flow needs, and you will also want to know how different asset classes have performed historically. And then you're going to want to make some forward-looking assumptions about how the asset classes will perform going forward. So now that we have an idea of how to define asset allocation, why do we even say asset allocation is important in the first place? Well, this all started back in 1986 with it's called the BHB study. It's the Brinson, Hood, and Biebauer study. It was updated in 1991. And in that study, they concluded that asset allocation explained 93.6% of the variation in a portfolio's quarterly returns, and that stock picking and market timing played minor roles. Some of the more recent discussions around this early work is that its focus was on the variability of returns, not on return levels or relative performance, which is what most investors are interested in. So it's really the academic community that has informed our understanding of the importance of asset allocation. And I wanted to take a second to talk about diversification, because that's another word that gets thrown out there a lot. And I think of diversification different than I think of asset allocation. I define diversification as, especially in a retirement portfolio, a withdrawal strategy, diversifying your investments for retirement cash flow planning. The first step is to diversify the time horizon when you're going to need the money. Then, depending on how long before you need access to the investments, will determine how much risk you should take for each time segment. Once we know how much you plan to spend, again, key is how much you plan to spend. Think about this whole thing. The reason you saved it in the first place was to spend it. Once we know how much you plan to spend, each time segment, we would create an asset allocation strategy to match up with each segment of the plan. The segments needed in the early years would be invested more conservatively, while the segments that are needed in the later years would be invested more aggressively. This concept seems pretty easy to understand, but from my experience and from meeting with a lot of people out there, a lot of people like the idea. They think it makes sense, but very few actually implement it. So now that we know what asset allocation is and why it's important to look at it, let's look at how this applies to you as you shift from making the transition from the accumulation phase of asset allocation into the distribution phase of asset allocation. If you're a visual learner, I want to encourage you to visit the show notes for episode number 316, because I'm going to include a link to this table that's very colorful, and it's a great tool for people who are geared toward visual learning. We're going to look at what's called the Callan periodic table of investment returns, and I'm hoping to be able to paint a picture for you over the podcast. I'm going to do my best to describe to you what I'm looking at, but if you'll imagine a spreadsheet or a grid or a table, if you will, along the top of the spreadsheet are columns, and each column represents a year, starting with the year 2000 and going through the year 2019. In each row of the column are colorful little boxes. In each of these boxes, each of these colorful little boxes represent an asset class. The asset classes being represented are as follows: real estate, U.S. fixed income, cash, small cap equity, global fixed income excluding the United States, high yield, large cap equity, international developed, excluding the United States, and emerging markets. Again, if you go to the show notes for this episode, number 316, I'll include a link so that you can follow along. But this colorful table really helps to illustrate that no one asset class is consistently the top or the bottom performer. But if you're like me, what you try to do is recognize patterns, and you think to yourself, boy, if I could just identify the asset class that's consistently at the top, wouldn't that be a winning strategy? Or maybe just avoid the asset classes that are consistently at the bottom. I think the chart does a pretty good job. The table does a pretty good job of showing you why trying to play that game is not going to get you very far. But a couple of things that I did notice as I looked at kind of the top performers and the bottom performers over this period from 2000 to 2019, the asset classes that consistently showed up the most in that very top, the best performer, real estate showed up 5 times, as did emerging markets 5 times out of the last 20 years. U.S. fixed income showed up 3 times, and so did small cap equity. Large cap equity was in the top spot twice, and then global fixed income was in that top spot once, and cash was in the top spot once. If I look at the bottom performers over this period of time, cash was the very worst performer 8 times over this 20-year period. Emerging markets was there 4 times. Global fixed income and developed international, excluding the United States, was there twice. And then large cap equity, U.S. fixed income, and real estate were all there 1 time.